Hi, this is Robert Kiyosaki, and I'm here with Ken McElroy. He is my personal friend, advisor, investor. I invest with him. We've made millions of dollars together, and he's the author of the Rich Dad books on real estate. So what we're going to be talking about today is an update on the real estate investing, not only in America, but throughout the world. And the real estate market all throughout the world is changing at a high rate of speed. So this is kind of an update, but Kenny and I will also be talking about the fundamentals of investing in real estate, because these are not ordinary times. And so often I meet people come up to me and they say, hey, I'm jumping into real estate. And I think that's one of the most stupid things you can do. So with that, I want to introduce Kenny, one of my best friends, but also my personal advisor, but also a person who's made me a multimillionaire over and over again. So Kenny, what do you have to say to somebody who wants to just jump into real estate?
Well, first of all, I always ask them why. It's a lot of people want to, but I think they feel like it's super easy and they can get rich quick. So that's usually the reason they say it. But if it's not always, but sometimes it's a long-term strategy. And then if they say that, then I love it, because then that's really what it is. It's a long-term strategy of cash flow.
Correct. And so let me give you, Kenny and I come from different backgrounds when it comes to real estate. I've never been in the real estate business. I don't have a real estate salesman's license or any of that. So I went and took a real estate course way back in 1973. It was 300. I was watching a TV infomercial in Hawaii. I was still flying for the Marine Corps. And I asked my rich dad, can you teach me about real estate? And he said, that's not my job. Your job is to learn about real estate. So why don't you just teach me? He says, that's not my job. So he says, go learn for yourself. And so I still remember I was in Honolulu. I was flying out of Hawaii. And I was watching this infomercial, and it says, you too can become a multimillionaire with nothing down investing in real estate. So since I had nothing down anyway, I called up and I said, sign me up. So the course was free. The introductory course was free. And so I strolled into it, and it cost $385, which I really didn't have because I was making about $600 a month as a Marine pilot. So $385 was a lot of money for me. But I signed up for the course. I figured out how to get the money, as we can all do. And I took this 3-day course. And that's how I started in real estate. And the most important lesson my advisor or the teacher gave me, the guy was sort of like Ken, a real real estate professional. He said to our class, there's about 30 of us in the class, and he says, ladies and gentlemen, your education begins the day you leave this class. And he says, what you do when you leave this class will determine whether or not you become a real estate investor or not. And his assignment was that each of us in the class had to look at 100 properties, do a one-page evaluation on the property, why it was good or bad, pros and cons of it, in 90 days. So the assignment was 100 properties in 90 days, one-page written documentation why it was good or bad, evaluation, not very sophisticated. And everybody in the class, let's say there's 30 of us, we all agreed we'd all do it. At the end of 90 days, I think 5 of us completed it, which is usually the stats there are about it. And so let's say 25 dropped out. And that's why they're not successful. So one of the things I was looking for a nothing down piece of real estate, and I found on an island of Maui, which, as somebody may know, is some of the most expensive real estate in Hawaii. And I found a 1-bedroom, 1-bath condo on the beach. It was $18,000 down. So I gave him my credit card. I put $1,800 down, and I made $25 a month. In other words, I made $25 a month with nothing. I used 100% debt. So the course kept the promise that they would teach me how to make money with nothing down, but I had to do the work. So that's how I got started in real estate. So Kenny, how'd you get started in real estate?
Thanks, Robert. Well, it's interesting now. People look at us now. We have $1 billion in real estate and 10,000 apartments and 300 employees, et cetera, et cetera, et cetera. But I started very similarly, like you. I was in college 30 years ago, and my buddy said, "Hey, would you manage this apartment building, for free rent?" And I said, "Yes, I will, because free rent is good." And I was racking up student loans and going through school. And so the idea of managing a property, it was only 60 units, but I remember it wasn't easy. And, collecting rent and maintenance and all that kind of stuff, I was like, how hard can it be? So that was my first experience in real estate, really. And the guy who owned the building came, I would deposit all the money, and then he would show up in his nice Mercedes, and he would sit down and he'd go, "Thank you very much for keeping the property full," and then he would drive off his Mercedes. And I was like, okay, I'm on the wrong side of the desk here. Like something's wrong. And I was just finishing school. I was in the business school. And so really, I just decided at that point, I was going to get my real estate license at the same time. So I started to get my real estate license and got that. And then I went to work directly right out of university for a very large company that does commercial real estate and brokerage and land development, property management, and all that, based in Seattle, which is where I'm from. And boy, did my education start there. I started managing properties. And so for the first 10 years of my career, I was managing properties. I probably managed somewhere between 20 and 30,000 apartments up and down the Western United States. And then at some point, I decided to start to buy them and own them myself. And so I've been doing that for 20 years, but I've been in the real estate business for 30.
So the point that Kenny makes, which everybody should listen to there, is that he got his experience. And he got experience not in the acquisition necessarily, but the hardest part about real estate, which is the management. And yes. when I look at people who lose money in real estate, they're pretty good at buying, because almost any idiot can buy a property. You have to be very smart to manage the property. And so that's why when Kim and I started investing in real estate 30 something years ago, is that we bought our first property, but she managed it. And then although she has a business degree, that's when she really started to learn about business. Is not only acquiring the property, was a 2-bedroom, 1-bath house in Portland, Oregon, but she learned more by managing it. And I think that's one of the key reasons that people fail at real estate, because they can't manage. And so when Kim and I met Kenny, and he found out he could manage real estate, he was like a godsend to us. God, we really wanted to partner with Kenny. So Kim and I at that time had about 40 rental units. And so Kim asked Kenny, says, "Kenny, would you manage my properties for us?" And I don't remember if you know what you said to her, Kenny, but you deflated her balloon so hard.
Sorry.
It was like, because up to then we thought we were Donald Trump. We had 40 units, And what did you say to her about?
Well, yeah, I just, what happened is, as you evolve and you start to buy properties, at that point, I think when you and I met, and Kim, I had already owned, several thousand units at that time, and we were just handling properties that were 200 units and larger. So that was, because it takes a lot of effort to manage anything. So a 40-unit building is hard. So is a 200-unit building, but really they're not that much different. The basics are pretty much the same. And so a 40-unit building is not very profitable, or even, a 10-unit or 12-unit or 8-unit is not very profitable for any property manager, really. So that's why I had already, been in the business long enough to know that 150 to 200 units is really required for us in order to even make a profit in the management side.
So that's one of the biggest lessons that if you could listen to what the fundamentals are, is start small. And as Kenny knows, Kim is a far better real estate investor than me, because she has the management experience. And management of property is the management of people. And when I was a kid starting out, when I was 10 years old, one of the first jobs my rich dad gave me, his son and me, Mike, was in Hawaii. We collected rent. You haven't lived until you've collected rent.
Yeah.
You'll hear every bullshit story, every lie, every victim, everything you could ever think about. And so Mike and I would be pounding on these doors as little kids and say, hey, you're 30 days, your rent's behind. And then you hear lie, cheating, stealing, BS, and all this stuff. And the hard part was, if we didn't collect the rent, we had to go talk to Rich Dad. So the question for Mike and me was, which is worse, this tenant or Rich Dad? And finally, we grew some backbone, cojones, and we started pressing the guys for the rent. And it was even worse when they totaled it. You know, sometimes we peek in the unit, and these guys had dogs and chickens and cats and donkeys inside their units. And they were destroying the property. And that's when you really start to understand management. So Kenny, is that true today? I mean,
yeah. So as you know, the backstory of how Kim and Robert and I met was I was already in the business full on, and I actually I was raising money, and this guy said to me, "Hey, you should meet Robert and Kim," because we both lived in Phoenix at the time. And I went down. I read your book before I met with you, Robert, Rich Dad Poor Dad. And I said, I want to know, get in this guy's head and figure it out. And this was brand new. The Rich Dad Poor Dad was just out. It wasn't the big hit that it is now. But I remember in the book, you actually said the most important person on your team is a property manager. And so I had actually never read that before, because I knew. Now, keep in mind, I was in the trenches at that time. And what happened in my world was people would buy real estate. I have a great story of a guy that he had a property that was 75 units, fully rented, cash flowing like crazy. He was out on a sailboat. He lived in San Diego, and a broker convinced him to sell that and to buy a 140 unit in Mesa, Arizona. Okay. So he did that. It's called the 1031 tax deferred exchange. But here's what I remember the most. He called me the day they were closing. He said, we need a manager. And unfortunately, this is what happens. So what he really needed was a property manager to actually look at that 140 unit in Mesa and tell him whether it was a good deal or not. Because the broker, they're just working for commissions. The property managers, they're the ones that actually have to make it perform. And so what happened was, he was so far behind, he was already committed and he had to close. And so he ended up buying it. And here's the problem. The property was filled with a bunch of bad things. So we actually it was already had a lot of vacancy. It had a lot of deferred maintenance. And in addition to that, we had to evict a number of people that weren't paying rent, because, why would you rent to anybody that can't pay? And so pretty soon the occupancy on that thing was like 60, 70%. And so then guess what he did? He fired us. You know what I mean? He's like, oh, it can't be my fault. And I'm like, dude, you bought a mess. And so we'll clean it up for you. And it took a while. It took like 8 or 10 months. But finally, he was trying to, project back onto me, like as if I had something to do with it. I'm like, all I'm trying to do is fill this thing up with good people, and he's like, well, now I'm like flying over to Phoenix all the time. I'm working all the time. And I go, dude, you sold 100% occupied boat property that had a lot of cash flow. You're sitting out on your boat, and now you're flying to Phoenix, and you bought this property that's, in a borderline area. It's your own fault. He didn't want anything to hear about it. And the point is that, people, like you said in the beginning, Robert, it's easy to buy something. It honestly is easy. It's not that hard to get money. Having money can be very dangerous, and so people are doing that right now. And that was a great example where a guy, he had a comfortable life, and then all of a sudden it was riddled with, and he fired the property manager after that, and then he ended up selling the property again for a loss.
And sometimes those are your best investments.
Yeah, I know. I wish I was just managing property at that time, and I wish I would have had the cash, because I would have went in and swooped in and and bought that thing. Cause it really, it takes a while to turn around a property. In some cases it's taken me a year and a half on big ones. We have a 680 unit property in San Antonio, Texas, for example. It was, I think, remember you and I went to it. It was 300 units. There were 300 vacant when we bought it.
Wait. What's worse than that? It was the worst property I've ever seen. We walk into the first unit. All the walls are taken out because they took all the wire out of it. And sitting in front of the fireplace was the toilet. I'm looking at that and I said, and Kenny says, God, this is a good deal. I said, there's an effing toilet sitting in front of the fireplace. All the drywall is taken out. All the copper wire is taken out. And there's no carpet. And I said, Kenny says, this is the best deal he's ever seen. This is the worst I've ever seen. But the guy I listened to was the guy that turned the property. What was his name?
Yeah, Ken. His name was Ken also. Yeah, remember? And no, you're right. He was the property manager.
Yeah, he looked at this thing and says, he said to me on the side, he says, this is the best deal I've ever seen. I said, either you guys are nuts or I'm blind. I'm missing something here. And that turned out to be one of the best cash on cash returns we have.
Still in the last 10 years, it's been the best deal that I've been able to buy. We bought it for $25 million. We got the bank to write down another 3. So our basis was like 22. And then we put 7 into it and now it's worth over 60. And we got our money back.
And the bank loans you the money to rehab it, right?
Yes, right. So that is actually the power of real estate investing, is seeing that, as you say, Robert, a lot, you say, deals are done in your mind. It's something that you see that no one else sees. And I knew in 2 years, I would be able to turn that property around, put new debt on it, get all the investor money back and own it free and clear, or as we like to say, infinite returns.
Yeah, infinite return is we get money, but we have no money in the deal.
Right. We still own that building. We have 30 million in equity in that deal, just the one. And it kicks off about 800,000 a year in cash flow. And we have no money in the deal. And that's a property that we own right now today.
And because it's real estate, we get to write off depreciation, amortization, and appreciation. So
right.
It's really a great deal. The point here, as I want to make, is that if you can't do that, you should stick with stocks and bonds, because there's one word about property that is bad. Property is not liquid. In other words, the moment you buy it, you own it. And if you've made a mistake and it's the SS Titanic, you're going down with it. So that's why you better know what you're doing before you buy it, because if you make a mistake, you can't sell it. And that's what I see happening to so many people. They just jump into real estate thinking it's a mutual fund or an ETF or an REIT, but then they can't get out of it because it's illiquid. And so that's why real estate requires much more financial education and real life education than stocks and bonds and mutual funds. Any comments on that, Kenny?
Yeah, I think that probably the thing that I would just want all the listeners to know is that before I buy something literally before we close on it, we already know what the value is going to be in year 1 and year 2 and year 3. And we already know how we're going to get our equity back. And it's almost never via sale, almost never. So in other words, we don't buy to sell. We buy to hold in cash flow, and it's a very different philosophy. And that takes a tremendous amount of experience and education.
And a team to do it.
Yeah. And it's so worth it, but the thing is even if you don't know how to do it, there are lots of people that will help assist you in that. Remember, I was telling you about my billboard story, how we're buying billboards. I didn't know anything about billboards, but there's lots of people that know them. There's lots of people that put ads on them. There's lots of people that own them. There's lots of people that manage them. But so I just found the people that could help me understand it. That's all. And they're out there, and these people are everywhere. And that's the mistake the guy from San Diego made, is that he just thought, well, I can roll my money from my San Diego property into one in Phoenix, and it's going to do the same thing. And, I don't really need a team. I don't need to understand it because it's going to be full just like the one I have. Well, it's not the case. He bought it in a very bad area. And so you have to have that team.
Is the end near? Yeah, I think it is. For decades now, I've watched the Fed, the banks, and the government play games with our money. They print trillions, devalue the dollar, steal your wealth through inflation, and tax away the rest. And behind the scenes, they've been selling gold and silver forward just to keep prices down, to keep you asleep. But the con is falling apart, and when it breaks, silver won't just go up, it could explode. I've been preparing for this since 1965, and I believe the reckoning could hit by September. Silver is still one of the most undervalued assets on Earth. It's essential to electric vehicles, solar, AI, water tech, even military systems. But here's the problem. Supply is disappearing. Meanwhile, demand is surging. That's why I believe silver could double, or even 5x this year. But don't expect to hear that on CNBC. They want you chasing fake assets, trusting Wall Street, praying the Fed will save you. Don't fall for it. If you want to build real wealth, think like an entrepreneur. Own real assets. Yes, I like gold. I own gold, but right now, silver is the best investment in the world. If you're serious about silver, here's what I recommend. Text the word silver to 24999. You'll get my brand new 2025 Rich Dad's Guide to Silver, free from my friends at Priority Gold. Inside, I break it all down. What's really driving silver, why it's still dirt cheap, and how to buy smart before the next big move. Look, the system isn't going to fix itself. Take control. Start now. Text silver to 24999 and claim your free guide while silver is still cheap. That's silver to 24999.
And there's one more thing that I learned the hard way is that when a salesman, a real estate broker, and as I would say, the reason they call them brokers is because they're a broker than you are, and they have to sell you this property. And it's not against the law to lie. So they'll give you all these numbers called a pro forma. And a lot of times a pro forma really should begin with the words once upon a time or in a perfect world. They're lies. So Kenny, if you were looking at a property like the building I'm in right now that I own, and I gave you a pro forma, the broker gave you a pro forma, would you believe the numbers?
Well, no, there's several reasons. I always take the position that they're, that maybe they are trying to lie, but I always take the position that they just don't know the property. And so a broker doesn't understand management generally. Most of them, some of them do, some of the very good ones do, but most of them don't. Most of them are just trying to get a listing and sell it to the next person and move on. And
commission.
Yeah, their commission, or, as we like to call it, tips, so that's the position I take every single time. I take the position. And so I always, because I have the knowledge and the experience, then I'm always managing the broker. So I'm always saying, well, I understand that I just had this scenario 2 weeks ago. I understand that you start your first month at 92% occupancy in your pro forma or your budget, but the property is at 78% occupied today. So if you buy it today, the beginning number should be 78%, not 92. So how can you know what I mean? So you just get into the nuts and bolts of what really is. And so what you're always trying to do is you're always trying to buy the property on how it's operating today, period. That's what you want to buy it on. You want to buy it on how it's operating today, and then you want to turn it into some value.
Well, this is my question, because this is what I was really weak at, which Kim is really good at, is how do you get the real numbers? So when you're looking at a property, you have the stuff that the sales sheet the broker gives you. But what do you do next if you're interested to get the real numbers?
It's a great question. So here's what we do. First of all, they're almost never correct, as you pointed out, when you get them. But if you know what the area, if you're really studying an area and you understand an area, so we'll just pick San Antonio, like where we were. What I knew was even what the broker had was lower than what the market was. So it's the equivalent of seeing a $200,000 house in an area where everything's selling for 250 or something like that, except it's on the rent side. So I already knew that, but I actually, as you pointed out, I already knew it was worse, right? I already knew that whatever the broker said it was, because what the brokers do is they take whatever the last few leases were, even that might be wrong, and then they say, okay, that's what the whole property is. Well, really, there's what we call legacy issues, where you got tenants that have been in there 1 year, 2 year, 3 year, 5 year, in this particular case, even longer. Their rents might be $100, $200, $300, $400 under the market. And so what you have to do is understand that there's a lot of room there. And so what we do is, if we see that there's a lot of market lift, even from what the broker says to what the market is, then we like to go in and make an offer. And then from there, we get into due diligence, and that's where the magic happens. So we'll pull every single lease on every single file. So on the property that you visited, Robert, the backstory of it is, of the 350 units or plus or minus that were occupied, we pull every single lease and we do our own rent roll and we figure out what our own rents are. You know what I mean? And so that's what we did. And then we put together our own projections based on our due diligence timeframe.
So for those of you who listen to this thing, if you're just starting out in real estate, don't jump in. Don't start with 100 units. Maybe start with a duplex or 4 units. And then you'll learn more from those 4 units. And if you've made some serious mistake, you might be able to get out quicker. But when people buy large properties they can't get out, that's when the whole thing comes out like a house of cards. So that's what I enjoyed about Kenny, working with him, because I learned more from bad properties than from pristine properties. And so anything else would you suggest that people look at and do before jumping in?
Yeah, well, I think what happens is, what you want, the biggest thing for me is sometimes you can even make a mistake on the buy in a real estate market. Like, in other words, maybe you're buying in at and you're not getting a great deal. But if the market itself is really jumping, like Phoenix right now, as you know, Robert, is one of the fastest growing. Arizona was the fastest growing state. So that's a result of a lot of job growth, a lot of population growth, and people are moving here, et cetera, et cetera, et cetera.
That's also California, people leaving California.
That's right. Yeah, because of tax and high expenses, et cetera, et cetera, et cetera. So what you can take a look at, sometimes that will save you. So in other words, sometimes demographics, when there's stress on supply and demand, so there's more people moving to Arizona than there are housing, let's say, well, then housing's going to go up, period. Rents are going to go up. Land prices are going to go up. All that's going to go up because there's a lot of people trying to buy in an area that has, small demand. It can work the other way around, as you know, like in Detroit, you know what I mean? When everybody moved out, not everybody, but, when the manufacturing stopped and blah, 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 and all of a sudden the real estate started to go down. So sometimes you can buy in a market and the market can save you, but you really need to understand both.
So for those of you, please pay attention, because remember our friend Richard Tan?
Yes, I remember this.
He's the funniest guy in real estate I've ever seen. He's such a dear friend of ours, but we're just friends because we need some entertainment in this business.
Remember we were on stage in Singapore, and he put that map up on behind us?
Yeah, the guy here, so Richard says, I did what you guys advised. I'm investing in America. And what was this mistake, Kenny?
Okay, so first of all, he's like, we're on stage and he's happy. Remember this? He was so excited. He's like, I finally bought some real estate. And so the first piece that he bought was a church. Remember?
Yeah.
And then I said, oh, great. So that could be a good investment. How much is the church paying you? Well, I felt bad charging him rent. So he bought the building, but he didn't have any income. So that was the first thing.
Because Richard and Veronica Tan they're true Christians. And I reserve those words for true Christians. They really are. They practice what they preach. They're very good people.
Incredible people.
Very incredible.
So, but it was funny because I said, okay, well, Richard, when you buy some real estate, it's okay that you bought a church and let them rent free. That's fine. But it's not necessarily going to be a good deal for you. Unless the church goes up over time. But on the one though, then he showed the picture of the United States. And keep in mind, we're in Singapore. And he's like, had a dot. He said, I bought a property right here. I remember we turned around and we looked at it on the screen. And I said, I go to Richard, Richard, I think that's Mexico. And it was Mexico. He bought a property, he thought in North America, but it was in Mexico. It wasn't even in the United States. But this is a guy with money that, just sent his money, wired his money around and bought properties, unknowing that. And he also I remember he bought a hotel that was half finished and all this stuff. It's that, so there's a lot of people that do that. A lot of people that throw their money around like that.
So Richard, the good news is Richard's gotten a lot smarter because the way we all get smarter is by being stupid. We've all been stupid, made our mistakes. So he's become very, very successful. But Richard has one bad habit. He starts big.
Yeah.
Our lesson is start small.
Yeah.
Mistakes are smaller. So the other point that we can get on with this is that markets are always changing. And, Kenny, one thing I respect about Kenny as a real professional, you're always attending seminars and classes and, things like that. I remember one of the last times I talked to you, you went to a real estate seminar run by millennials who were teaching how to use information.
AI. Yeah. So I flew to Seattle. It's cool because sometimes when I do go to those, they want me to speak. And so I did speak up there with Bigger Pockets and a bunch of guys, because there's a whole generation coming up behind me. And it's so fun to watch. And so they're trying to figure out how to do more with less, through apps and cell phones and things like that. And the fact is that the real estate industry, largely, even property management, is antiquated. It's a lot of paper and a lot of this and a lot of that. And so these guys were fascinating to hear. These guys were managing hundreds of houses, all automated, with apps and property management tools on their phones. And for me, it was really eye-opening. And the great thing is I was able to come back because we have a property management company as well. That's where the majority of our employees are. And I was able to sit down with the CEO of our company and start to overhaul our whole company and say, hey, how do we automate more? How do we automate all the way? How do we make it easier for the resident? How do we make it easier for the property managers and easier for the investors so that everybody can see everything and be super transparent? So it was exciting.
And then, markets are always changing, but, around 2006, 2007, we didn't have as many properties as we do today, but people were leaving our properties to buy these giant homes. I mean, Ken and I were sitting there, our vacancies are going up because people are leaving to buy these mansions they can't afford. Remember that?
Oh boy, do I ever. Yeah, I remember because we screen all of our residents, obviously. You want to, so you have to. You basically, they pay you to run their credit. And you want to, obviously, if you're going to rent something, you want to rent it to somebody that can afford it. And so, we get all their data, we know where they're working, we know, their past credit history, all that kind of stuff. And so at the same time that we're actually denying some people, those people who were actually buying condos and houses. So the people that we were actually denying to move in as a renter. And so that's what, I remember you and I were sitting there and I said, Robert, I'm telling you what I'm seeing at the occupancy level is that we're actually seeing people with pretty bad credit that are that can't even really afford to pay rent that are actually buying homes right now. And I said, this is going to turn into some kind of a bigger problem.
So I remember, it was kind of frightening because our vacancies are going up. When vacancy goes up, cash flow goes down for us. And all we could say was, let's just wait because something's going to happen. And when it happens, we'll move back in.
Yeah. And that's what we did.
So 2008.
It took years, but it did happen.
Yeah. So when Lehman Brothers came down in September 2008, that was kind of a sign from God, because that's when we moved in and fast. That's because prices of real estate were coming down and interest rates were coming down.
Yeah.
It was a perfect storm, wasn't it?
It was. It's interesting because if you really want to get super simple about what happened, people were giving people money that couldn't pay it back, period. That's what happened. And that all of a sudden everything fell. That's why they call it the big short. People that recognize that, you can give anybody money anytime. You can give $100, $1,000, $1 million. If they can't pay it back, there's a default. And that's actually what happened on a big scale.
So what happened after the crash?
So that's when all the banks and institutions started taking that real estate back. And so
wasn't that when you made some of the best buys ever?
Absolutely. That's when we saw that San Antonio property, that was owned by Bank of America. They had lent on that, and it was 50% occupied, and it was what we would call bank owned. So yes, that's when you see all those things. It's incredibly difficult at that time though, Robert, as you know, to buy, because everybody's hunkering down. Everybody's scared. Everybody's hunkering down on their money. The investors are going, real estate's a terrible, terrible time. And so that's when you have to have your team together. You have to have your systems together, and you have to be ready for that. And that's what most people miss. Most people jump in when all that's fixed, and I remember we were joking. I said, when the checkout person at Target is giving me a real estate tip as I'm Christmas shopping, I said, there's a problem. Or you're hearing at a lot of cocktail parties, the party's over, folks, at that time. And right now it's kind of the same time. Even though I still think we have a lot of run in the market in some areas, not all, it's a dangerous time to come into the market.
And that's what I was getting at, is because when this is in 2007, 2008, everybody was flipping houses. And that's when, I was talking to Kenny, and he says, I don't flip. And I said, I don't flip either, because Kenny and I are cash flow people. We want the property to pay us an income for the rest of our lives, or as long as we hold the property. Well, all these people that were jumping in were flippers. So they want to make the quick buck. And my concern is that's kind of where we're at today. And I was looking at the real estate section of the Wall Street Journal and New York Times, and people are just euphoric because the prices are at all-time highs, just like the stock market. The NASDAQ, S&P at all-time highs right now. And that's when the amateurs jump in, which includes real estate. So the part I wanted to get to today is ask Kenny what you're looking for, because I think we're more cautious now. I am more scared. I am more scared now than I was in 2008. In 2008, I was just glad it was crashing.
Yeah. How much more room do we have in this particular market, and where are we? And if you look at the money, that it's backing off. Rents are topping. Occupancies are not as high as they were. Cap rates are starting to go up. Capitalization rates, as you know, we sold that big portfolio of ours, Robert, almost $300 million worth of stuff in the last 14 months. And our cap rates were in the low 4.2, which is really low. And so, if you don't understand cap rates, then you better be careful, because they're important as you invest. And so what we're starting to see.
Andy, could you, I'll give people the definition of cap rate you gave me. A cap rate of 4 means if a property is $1 million and you put $1 million in, your return is 4. Is that how you?
Yeah, that's pretty close. Yes, it's good enough. And so what happens though is that 4%, whatever it might be, that's generated from the property, from the net operating income, which is another formula, which is basically expenses after income. And so what happens though is if that cap rate goes to 5, then what happens is the value of the property goes down. And you have to jump. If you think about this, 4 to 5, the ratio is 20%. You actually have to grow your net operating income by 20% just to break even. And a 20% growth in net operating income is super hard to do. And if the cap rates go down at all and there's any softness, especially with interest rates, then I'm telling you that these properties are not worth what people are paying today. And all of a sudden they're going to be underwater with their mortgages or the things they're not going to cash flow like they should.
Right. So in spite of prices being high, the market being volatile and all that, are there still opportunities out there?
There are. I got to tell you, it's interesting. On my podcast, I just had a guy that's investing in mobile home parks as an example. And, mobile home parks were not even on the radar. People weren't even talking about them years ago. But let me tell you what they are. They're land plays covered by rent. And, these are affordable places. And so they're buying these things, 100, 200, 300 unit mobile home parks. And they're, the rents are $600, $700, $800 a month. They don't actually own. Sometimes they bring their own and they stick it there, but they get basically a rent for the space. And, the people own their own place, or in some cases they don't own their own place and they just charge them rent. The point is that more and more people are moving to what I would call affordability. That's one of the big things, it is, affordability and rent control, all that stuff's coming, Robert, as you know. It's already here.
So anyway, thank you for your time. Thank you for your education. There's always an opportunity out there, but I think you've got to be a professional at this. So any final words would you say to somebody who's thinking about jumping into real estate? What would your final words be?
Well,
buy your 3 books, of course. Start with that. It's cheaper than
education.
Down payment.
Education is everything. As you know, Robert, honestly, find yourself some mentors, find yourself a group of people that are like-minded and like to study. Even I, Robert, and you and I, we study a lot. That's why I created the KenMcElroy.com, the web, the videos and all that stuff. So people could just go on there and study and learn from real experts. That's where, you can only get so much out of a textbook though. And you can only get so much out of a video. You actually have to go out and like you did with your stuff in Maui, and go out and actually learn, that's how you really learn. But do that first before you spend your money or somebody else's money. And, because the market's not always going to go up.
So thank all of you for watching Kenny and myself discuss this very important subject called real estate. When people say, do what you love, I really think it's also invest in what you love. And I really love real estate, which can be a problem because I bought some really bad real estate because I loved it. So, if you love it, study it, be a professional, have mentors, and I think make it a lifelong plan to keep acquiring real estate. So thank you, Kenny.
Yeah, thank you, Robert. Always great chatting with you.
Thank you for listening.
This podcast is a presentation of Rich Dad Media Network.